Hey everyone, welcome back to Corporate Decoder, the place where we uncover the shady dealings behind your favorite publicly traded companies. Today we're diving into OTG Acquisition Corp, ICE's Q2 earnings report, and let me tell you, this one's got more twists than a pretzel on deadline day. Stick around to see if this blank check company is heading for a blank check for success, or a big fat zero. Alright, let's get straight to it. OTG Acquisition Corp. I is a special kind of company, what they call a blank check company. Think of it like this, they exist to find another company to buy and merge with. They had their big initial public offering, or IPO, in September 2025. This whole document is their quarterly report showing what has been happening in the 3 months ending the 30th of June 2025. Now let's peek at their balance sheet as of the 30th of June 2025. It is not exactly bursting with assets. We see total assets are just over $171,000. That is not a lot, especially when you consider their liabilities are over $161,000. This leaves them with shareholders' equity of only about $10,000. It's like there, starting with a shoestring budget and a prayer. The main chunk of their shareholders' equity comes from Class B ordinary shares. They have 5.75 million of these. Interestingly, a portion of these shares, about 750,000 of them, were subject to forfeiture depending on how the underwriters exercise their over-allotment option. But good news for the holders. It looks like that option was fully exercised on the 15th of September, so those shares are no longer at risk of being taken back. Moving on to their operations, and well, there is not much to report there. For the period from their inception on the 12th of June 2025 through the 30th of June 2025, they're in 2025, their entire operation consisted of general and administrative costs amounting to about $14,500. This resulted in a net loss of exactly the same amount. They are pretty much in startup mode, burning through cash just to get things rolling. The weighted average shares outstanding for Class B ordinary shares during this short period was 5 million, and the net loss per S-share, a tiny fraction of a cent, $0.00. So financially, they are in very early stages, which is expected for a company in this phase of its life cycle. Looking at the changes in shareholders' equity, it mirrors what we saw. They started with nothing and ended with a small positive equity after the issuance of Class B shares to the sponsor and accounting for the net loss. The sponsor put in $25,000 for these Class B shares, which is called additional paid-in capital, and that is what makes up the bulk of their equity. Their cash flow statement tells a similar story. They used about $14,500 in operating activities, mainly for those general and administrative costs. There were no significant investing or financing activities recorded in this very short period, which makes sense as they are just getting off the ground. It's important to note that the sponsor contributed $25,000 as prepaid expenses in exchange for those Class B shares. This isn't cash flowing into the company's bank account for operations, but rather an investment in equity. Let's dig a bit deeper into what this company is all about. OTG Acquisition Corp. As mentioned, is a blank check company. They were formed to find a business to combine with. They have not yet identified a specific target, which is pretty common at this stage. They are also an emerging growth company, which means they get some regulatory flexibility. But it also means they face all sorts of risks that early stage companies do. Their sponsor is named OTG Acquisition Sponsor LLC. This sponsor is essentially the driving force behind getting the company off the ground, often investing initial capital and providing expertise. Now, this is a key date, the 15th of September 2025. This is when they had their big initial public offering, selling 23 million units. Each unit was priced at $10, raising a massive $230 million. This offering included shares and warrants, which are basically options to buy shares later at a set price. They also sold private placement units to the sponsor and underwriters, bringing in an additional $7.75 million. But hold on, all that money raised wasn't pure profit. They paid out over $5.3 million in transaction costs, a big chunk of which was underwriting fees. That is a substantial amount just to get the IPO done. Most of the money from the IPO, over $231 million, went into a trust account. This money is meant to be used for their future business combination. It is held securely and can only be accessed for specific purposes related to acquiring another company, or if they can't find one, it is returned to the shareholders. They are following US generally accepted accounting principles, or US GAAP, which is the standard accounting framework in the United States. However, because this is an interim report, some of the usual detailed information is condensed or left out, as allowed by the Securities and Exchange Commission, or SEC. Before the IPO, their liquidity needs were met by a loan from the sponsor, up to $300,000. As of the 30th of June 2025, they had no cash and a working capital deficit of over $100,000. This highlights how critical the IPO funds were to their survival. A little detail here, there was a slight hiccup with the sponsor depositing $2 million related to the private placement units. Due to timing, it wasn't deposited right away and was treated as a receivable. But this was sorted out later. As an emerging growth company, they can take advantage of certain exemptions from reporting requirements. This means they might not have to follow all the same strict rules as older, more established companies. This can save them time and money, but it also means investors might have a bit less transparency. This section reiterates the details of the IPO, confirming the sale of 23 million units at $10 each, raising a substantial $230 million. It also mentions the underwriter's option to buy more units, which they fully exercised. This is where we see the financial dealings between the company and its sponsor. On the 16th of June 2025, the sponsor paid $25,000 for 5.75 million Class B shares, also known as founder shares. As we saw earlier, some of these shares had forfeiture conditions, but those were later removed. This note details the private placement units bought by the sponsor and underwriters. It clarifies that these units are similar to those sold in the IPO. There is also mention of potential working capital loans from the sponsor or affiliates, which could be repaid or even converted into units. They also had a promissory note from the sponsor for up to $300,000 to cover IPO expenses. As of the 30th of June 2025, about $39,000 was outstanding on this note. This was later fully repaid. An administrative support agreement was put in place starting the 11th of September 2025. They'll be paying $20,000 a month for office space and administrative services. This is a recurring cost they'll need to manage. This section talks about future obligations. They have registration rights for their shareholders, meaning they have to help shareholders register their shares for sale. The underwriting agreement details the fees paid to underwriters, and the business combination marketing agreement outlines fees for helping them find a target business. They'll pay the underwriters a significant 4% of the IPO proceeds, which is about $9.2 million if they successfully complete a business combination. Here is a crucial part that investors always look at the risks. They mention global economic volatility due to geopolitical events like the Russia, Ukraine, and Israel, Hamas conflicts. These conflicts can disrupt markets, cause supply chain issues, and even increase cyber attacks. They also touch upon changes in US trade policies and tariffs, which can affect international business. They also mention a new bill signed into law on the 4th of July, the One Big Beautiful Bill Act. They're still evaluating its impact, but they don't expect it to significantly affect their financials. Still, changes in tax laws are always something to keep an eye on. This note provides more detail on their share structure. They have authorized but unissued preference shares and Class A ordinary shares. The key is their Class B ordinary shares, which are primarily held by the sponsor. As we noted, the forfeiture conditions on some of these Class B shares were removed after the IPO. They also explain the voting rights of these shares, noting that prior to the business combination, only Class B shareholders have a say in director appointments. This details the warrants. They become exercisable after a business combination, but only if certain conditions are met, like having an effective registration statement. The exercise price is $11.5 per S-share. They also mention that if the share price drops significantly, the exercise price might be adjusted. This is important. The company won't redeem warrants at their option unless a registration statement is active, and if they can't complete a business combination within their specified timeframe, these warrants could expire worthless. This company operates in a single segment, their Chief Operating Decision Maker or CODM, which is essentially their CEO reviews the company's performance as a whole. They track general and administrative costs and total assets to make decisions about resource allocation. For assets, the CODM keeps an eye on prepaid expenses of about $54,300 and deferred offering costs of around $117,400. These are costs paid in advance for services that will be used later. On the expense side, general and administrative costs were about $14,500 for the period. These are the everyday costs of running the business, even if it is just getting set up. This section covers what happened after the 30th of June 2025, but before the report was officially published, it confirms the details of the IPO on the 15th of September 2025, including the 23 million units sold and the associated proceeds and costs. It also clarifies the full repayment of the sponsor loan and how the other received funds were handled. A final key event is that on the 22nd of October 2025, the sponsor settled the remaining share subscription receivable by depositing over $971,000 into the company's operating account. This means that the funds initially expected from the private placement are now fully in the company's hands. This part is management's own take on the company's situation. They explain their business strategy, which is to find and complete a business combination. They acknowledge incurring significant costs and not being able to guarantee success. They admit they had no revenues and incurred a net loss of about $14,500 due to general administrative expenses. They expect to keep spending money as they search for a target business. They reiterate their plan to use the IPO proceeds from the trust account for their business combination and the funds outside the trust account for due diligence and other expenses related to finding that target. Management believes they have enough funds to operate until their business combination, but they also hedge their bets, saying that if costs are higher than expected, they might need more money. They have no off-balance sheet arrangements. This is good. It means there are no hidden debts or commitments lurking in the shadows. Their only significant long-term contractual obligation is the $20,000 per month for administrative services we mentioned earlier. No long-term debt or lease obligations. As a smaller reporting company, they are not required to provide detailed market risk disclosures. They performed an evaluation of their disclosure controls and procedures and concluded they are effective. This means they have systems in place to make sure that important information is properly processed and reported in a timely manner. As far as they know, there are no major legal proceedings currently against the company or its officers and directors. They refer back to their IPO prospectus for risk factors, stating there have been no material changes to those risks since then. This means the risks they outlined when they went public are still the primary concerns. This section details the sales of founder shares to the sponsor and the private placement units, all made under an exemption from registration, which is typical for these types of early transactions. It also confirms the use of IPO proceeds, with a significant portion going into the trust account. Finally, this is the list of exhibits filed with the report, standard stuff like certifications from the CEO and CFO, and formatting files for electronic submission. So, what is the verdict on OTG Acquisition Corp? As of the 30th of June 2025, before their IPO. They were essentially a shell company existing on paper, with minimal assets and significant costs incurred just to get to the IPO stage. The real story begins after the 15th of September 2025, with the influx of millions of dollars from their IPO and private placements. Their biggest strength right now is having that substantial capital in the trust account, over $230 million, which gives them the firepower to pursue a business combination. However, their primary weakness is that they have no operations yet. Their entire future hinges on finding the right company to merge with, and there is no guarantee they will succeed. The risks outlined are the common ones for these types of companies. Failure to complete a business combination within the required timeframe leading to liquidation, or a poorly chosen acquisition that destroys value. The company direction is entirely focused on the acquisition hunt. The note about global market volatility and geopolitical risks is a significant external factor that could impact their merger strategy and the target industries they might consider. Our take is that this is a gamble. Like most SPACs, the management team has the funds to operate and search, but the success will be purely based on their ability to identify and close a valuable deal. If they pick wisely, they could create significant shareholder value. If they don't, those warrants could be worthless and the shares could plummet. It is a high-stakes game of finding a diamond in the rough. Alright? That is our deep dive into OTG Acquisition Corp, as latest filing. What is your take on this blank check company's future? Do you think they'll find a prize, or is this just a way to burn through investor cash? Drop your thoughts in the comments below. If this breakdown was helpful, give us a like and subscribe for more corporate insights. And don't forget to join our Discord community for even more exclusive content. The link is in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.